Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Tuesday, the 24th of June. I'm Daniel Lam, your host for the podcast. Last week, we've just published our second half global market outlook, in which we devoted a good section to de-dollarisation, which has been a key financial topic in this year. Well, in pretty much all of our listeners' lifetime, the US dollar has been the dominant currency in the world. So, let us not have emotions in our way and concentrate upon the numbers and facts. Now, the US dollar currently accounts for 58% of global foreign exchange reserves, more than 80% of global FX turnover, and 1/3 of global debt issuances. 20 years ago, the US dollar's reserve share was closer to 70%. Central banks have been diversifying steadily into the euro, yen, and sterling, as well as others such as Australian dollar and gold. However, the US dollar still dominates, and that's not changing soon. The main reason is because of a lack of strong alternative candidates. So, for example, the euro lacks a true fiscal union and deep bond and equity markets, and there are still capital controls on the RMB. So why do people talk about de-dollarisation? Well, there are three reasons: trade fragmentation, structural risk within the US, and geopolitical tensions. So in terms of trade, the US dollar still dominates trade between advanced economies and the emerging markets. But EM trade is increasingly bypassing the US dollar, with more transactions settled in local currencies or alternatives. So as of 2022, about 75% of global trade involved advanced economies, and only 25% was EM to EM or EM to China trade. That smaller size is where de-dollarisation has been gaining ground. Now, it is not enough yet to unseat the US dollar, but that's reshaping parts of the global economy, especially as EM to EM trade growth outpaces DM to EM trade growth in the coming years. Now, regarding the structural risk within the US federal debt is at nearly 99% of GDP in 2024 and projected to be at 118% within a decade, according to the US Congressional Budget Office. So this raises concerns about the long-term appeal of US government bonds as the world's preferred safe asset. Foreign ownership of US bonds is already falling. With slower reserve accumulation and greater diversification, foreign holdings of US bonds have dropped to about 30% of the outstanding amounts. So what about the shift in the behavior of the US dollar under different market conditions? How does geopolitical tensions come into all these? And what it ultimately means to investment portfolios? Please listen to Cut to the Chase for the second part of this podcast about de-dollarisation. Thank you.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.